Imagine this. Two investors, same market, same opportunities, but completely different results. Meet Alex. He watches the stock market like a hawk. Every time the news predicts a crash, he panics and sells. Then, when stocks are booming, he jumps back in, afraid of missing out. Now, meet Ben. He invests consistently, rain or shine. He doesn't get shaken by headlines. He plays the long game. Fast forward 10 years, Alex has lost money, despite his constant effort to time the market. But Ben, his wealth has doubled. So, what went wrong? The truth is, the biggest threat to your investments isn't the market. It's your own psychology. Most people think investing is all about numbers, data, and strategy, but in reality, it's a mental game. Studies show that 80% of retail investors underperform the market, not because of bad stocks, but because of bad decisions. So why do we make these mistakes? The answer lies in behavioral psychology. Nobel Prize-winning psychologist Daniel Kahneman explains this in his book Thinking Fast and Slow. He discovered that our brains are wired with biases that lead us to make irrational financial decisions without even realizing it. Fear, greed, overconfidence, loss aversion. These emotions drive most investors, and they often lead to failure. So, let's break down the biggest psychological traps that cause people to lose money, and how you can avoid them. Investing mistakes aren't just bad luck. They're deeply rooted in human psychology. Let's start with the most common one. Imagine an investor named Sarah. She has money to invest, but keeps hesitating. She saw the market crash in 2008, watched stocks fall in 2020, and now she's too afraid to take the plunge. Instead, she keeps her money in a low-interest savings account. Safe? Yes. Smart? Not really. Psychologists call this loss aversion, the idea that losses feel twice as painful as gains feel good. This is why investors panic sell when markets drop and hesitate to buy when prices are low, even though history shows that markets always recover over time. The fix? Shift your mindset. Understand that market dips are normal, and long-term investing wins. The S&P 500 has averaged around 10% annual returns over the last century, but only for those who stay in the game. Now, let's talk about the opposite mistake, jumping in too late. Meet John. He saw Bitcoin soaring in 2021. He saw Tesla stock doubling. He thought, I have to get in before I miss out. So he buys at the peak, only to watch prices crash right after. This is called recency bias, assuming what happened yesterday will keep happening tomorrow. We saw it in the dot-com bubble, the 2008 housing market, and again with meme stocks in 2021. People see an asset skyrocketing and assume it will never fall, but history tells us otherwise. The fix? Remember this rule. Past performance does not guarantee future results. Instead of chasing hype, focus on solid fundamentals. If a stock has already exploded in price, ask yourself, does it still have room to grow, or is it just FOMO? Ever heard the phrase, everyone's getting rich, why am I not in? That's how millions of investors felt during the crypto boom. Bitcoin was rising, NFTs were everywhere. Social media was flooded with success stories. So what happened? People rushed in, and then the bubble burst. Prices crashed. Millions lost money. This is called herd mentality, or FOMO investing. The fear of missing out makes us ignore logic and follow the crowd, assuming if everyone's doing it, it must be right. But history proves the crowd is often wrong. By the time a trend goes mainstream, the biggest gains are already gone. The fix? Do your own research. Ask yourself, would you still invest if no one else was talking about it? If the answer is no, it's probably FOMO. Imagine this. It's 2008. The stock market is in free fall. Investors are panicking. Headlines scream the worst crash since the Great Depression. People start selling everything, desperate to cut their losses. But not Warren Buffett. Instead of selling, he held his stocks. He even bought more. And when the market recovered, he doubled his wealth. This is the danger of panic selling. Fear makes us act irrationally. But history shows that markets always recover given time. Investors who sold in 2008 locked in losses. Those who stayed invested made everything back. and more. The fix? Stay calm. When markets crash, take a deep breath and remember, investing is a long game. The ones who win are those who wait. Picture this. You invest in a stock. A month later, it hasn't doubled. You start to worry, maybe it was a mistake. This is the trap of short-term thinking. Too many investors expect quick gains and panic when they don't see results fast enough. But ask any great investor and they'll tell you the same thing. Wealth isn't built overnight. Warren Buffett once said, "The stock market is a device for transferring money from the impatient to the patient." The fix? Think in decades, not days. The most successful investors don't chase short-term gains. They let time do the work. Let's be honest. We all like to think we're smarter than the market. You find a hidden gem stock. You're sure it'll explode. You go all in. Then it crashes, and you realize you weren't as right as you thought. This is overconfidence bias, the belief that we can outsmart the market when, in reality, even the pros struggle. Statistically, 90% of active traders lose money in the long run. The fix? Stop gambling. Start investing. The data is clear. Most stock pickers underperform. But index funds, they consistently outperform the majority of traders over time. Imagine putting all your money into a single stock, and then it crashes. That's what happened to investors in Enron, in FTX, in countless companies that seemed too big to fail, until they did. The mistake? No diversification. Too many investors go all in on one stock, one industry, or one trend, thinking it's a guaranteed win. But the truth is, even the best companies can collapse overnight. The fix? Spread your risk. Smart investors don't bet everything on one stock. They diversify. ETFs and index funds let you own hundreds of companies at once, balancing risk and reward. Most investors focus on what they earn, but forget what they lose. High fees and taxes silently eat away at your profits, sometimes by as much as 40% over time. Think about it. Small fee may not sound like much, but over 30 years, that tiny percentage can take hundreds of thousands out of your portfolio. The fix? Cut the hidden costs. Choose low-cost index funds. Use tax-efficient accounts. Keep more of your money. Investing isn't about chasing quick gains. It's about building lasting wealth. The most successful investors don't gamble. They strategize. The market moves in cycles. Today's downturn is tomorrow's opportunity. Ignore the short-term noise and stay committed to your long-term financial vision. Don't put all your eggs in one basket. Stocks, bonds, real estate, ETFs, and even alternative assets. Spreading risk means a smoother journey to wealth. Remove emotions from investing. Automate your contributions. Stick to a plan. The less you rely on feelings, the more you rely on strategy. A tiny percentage of fee may seem small, but over decades, it can cost you hundreds of thousands in lost returns. Understand tax-efficient investing. Maximize every dollar. Instead, use dollar-cost averaging. Invest steadily, no matter the market's mood. Over time, this reduces risk and builds serious wealth. Market crashes, they happen, but history shows markets recover and grow. The worst investment decision? Panic selling. At the end of the day, the best investors aren't the ones who react the fastest. They're the ones who stay patient, stay disciplined, and let time do the work. Markets change, economies shift. Stay informed, but avoid impulsive changes. A smart investor evolves, not panics. Stocks, real estate, startups, the best investments come from knowledge. Study industries, follow trends, be an expert, not a speculator. Inflation is silent but deadly. It shrinks your savings. Keep enough for emergencies, but invest in income-generating assets that grow over time. The wealthy don't just make money, they make their money work for them. Compounding is the secret weapon of every long-term investor. Let your returns create more returns. Build an emergency fund, have an exit strategy, insurance, asset protection. Smart investing isn't just about making money, it's about keeping it. Wealth isn't built overnight, it's built over time. The question is, will you start today?